Variable interest entities and beneficiaries. So what is a variable interest entity? You might see this. These are kind of my more interpretive terms here. So this is essentially a shell company, usually based in the Cayman Islands or other offshore location. It can be a corporation, partnership, trust, LLC, or other legal structure used for business purposes that either lacks equity investors with voting rights or financial resources to support its activities. The reason we're talking about this here is because a lot of times you might see a company, a shell company, owning 100% of a real company, right? That's for tax purposes. That's for many business reasons, right? So that is something to keep in mind when you see a variable interest entity. This is an entity that generally wholly owns one of the entities we're talking about. The primary beneficiary is the entity that is required to consolidate the variable interest entity. It is essentially the real company that is owned by the VIE or shell company, right? So let's say we've got, XYZ private equity fund. We've got shell company in the Cayman Islands owns XYZ equity fund. And here, right, this is the shell company that owns the primary beneficiary, the real company. The primary beneficiary has the power to direct the activities of the variable interest entity. So again, this is a shell company, doesn't really exist other than to give you some tax benefits. So, but the underlying, so this is basically saying the subsidiary has power over the parent, right? Because the parent's a shell company, doesn't really do anything. So that's kind of what this is saying. And because when we identify that this exists, we have slightly different treatment. We absorb the expected VIE losses or receive the VIE returns. We're not going to really see questions on this mathematically, just kind of conceptually, right? That's what we're talking about here. The questions we'll ask about them overall, right? This is just something new to kind of take in stride. Something that I don't really ever see it described this way anywhere else in CPA exam courses. So this is my take on it after doing my own research, which I think definitely helps to answer a lot of questions in the exam. Don't get me wrong, I'm not explaining things out of my own interest. I don't have any interest other than what is directly related to the exam. Well, identifying a variable interest in a business entity, when all the following criteria are met, a company is said to have a variable interest in another entity. So this doesn't have to be a shell company, right? This could also just be one company that has a strong variable interest in another. So the business is a legal entity. That's pretty important, right? I mean, you gotta have a business that's a legal entity. The company and the business entity have an arrangement. Okay, sounds good there. The interest is more than significant. Okay, so if you exist solely to own another company, that interest is more than insignificant. The company has an explicit or implicit variable interest in the entity. Again, now here's where we get interesting, right? Because let's say I don't own any of your company, but you maybe you only make $100,000 a year as a company, but you owe me $1 million in debt. Now that's a pretty big variable interest in your company. Even though there's no ownership, I mean, you still owe me a crazy amount of money, almost to the point where I could kind of have a say on what you do because it's going to take you at least 10 years to pay me back, probably more. And the business fails to qualify for an exclusion. What types of entities are usually not consolidated as VIEs? These are generally not-for-profit and government organizations. So we do not include government, not-for-profit organizations as VIEs. Also include employee benefit plans and registered investment companies. Those are known as RICs. We will not see any of these included as variable interest entities. What about more about a variable interest? Well, it does not necessarily have to be controlled through stock, like I was saying. If you owe me an insane amount of debt, right, I might have control over you just because of that. So some other ways that a variable interest could exist are through what? Well, explicit in writing and legally enforceable investment at risk or guarantees of debt or the values of assets. So other ways that we could have these relationships: implicit guarantees with related party involvement, most liabilities excluding short-term trade payable. That's just more vendor related. Most forward contracts to sell assets owned by the entity, and options to acquire leased assets at the end of lease terms at specified prices. All of these are going through different examples that we'll see, right? These are all basically indicating that there's more of a significant connection between the two entities rather than ownership. So essentially, these are all what you may call independence and pairing. And I like that term. probably because I came up with it and put it in here, or significant vested interests. I don't think I came up with that one. I probably just included that. But yeah, right here. So lots of these, if we were talking about audit, these would impair independence, right? And they kind of impair independence in terms of our legal structure. And that's why they are indicative of this variable interest entity.